title slide pretty much sums everything up. Nobody knows anything. I think that's a pretty good summation of the entire market situation that we're in right now. This is extremely fluid, extremely volatile. Who the hell knows, honestly, because so much of this is obviously depending on what's going on in the Ukraine right now. I mean, we're all hoping, I know I am, that the Ukrainians kick Vlad's ass, but the truth of the matter is, when you look at the size of the two contingents, I don't know that that's how it's going to turn out. I hope it is, but I think daily we're going to see these daily emotional swings based on what level of sanctions there are, how things are going on the ground, or how, to the extent any of us know, because of course the information is really not very good. But that's basically what we're going to be dealing with for a while now. And you know, without, I don't want to act like I know what's going to happen, but there's some general observations that I do kind of want to make. You know, right now we're not really sanctioning the big stuff. We're not really sanctioning oil. We're not really sanctioning grains. They're big. You know, I think a lot of the coal, in theory, can come out. A bunch of that goes east into China anyway. So I mean, really, at this stage, we're still not. I don't think we're inflicting as much economic pain as we probably could be, and I really don't know what the odds are of this getting cranked up again. I mean, honestly, Europe's making the right noises. I mean, Canada and the U.S., yeah, we can stop energy imports from Russia. Europe, it's a much taller order. I mean, they are making the right noises, but I have my doubts. It is worth noting, though, that there are non-sanctioned sanctions definitely going on. After what happened in 2014 in the Crimea, I think virtually every commercial carrier, every oil carrier, all of those ships, all of their insurance contracts pretty much say the same thing. And it's that even without a declaration of war, if there's a couple of ship losses, and there's been 3 or 4 already in the Black Sea, it effectively becomes a war zone, which basically means force majeure, no insurance. Obviously, most ships aren't going to want any part of that, because if something happens to them and they're not insured, they're screwed. And on top of that, it sounds like there are a significant number of captains, both in the fleets that deal with the oil and the fleets that deal with the grain, that are just saying, I'm not loading this stuff. Putin's a dick. I'm not going to help him get paid. Forget it. I'm just not doing it. And some of the ones that are getting loaded, there are apparently problems at the other end in North American and European ports, where the longshoremen are just saying, not touching that. So maybe there's more pain getting inflicted than is immediately apparent. I mean, we have seen oil go up to, you know, went up to 130. It's come all the way back to about, I think it's around 105 now. Maybe 130 was the top. I mean, that could be. If there's as much oil getting out as I think there is, that probably was the top. The bigger issue might actually be grain. Grain's basically, wheat's doubled in the last 2 weeks. Ukraine and Russia between them are far and away the largest wheat exporters in the world. There's real, and you know, they have the same issues. Almost all of that comes out through the Black Sea, so they've got those same insurance non-loading issues that the oil guys do. I mean, there's not, you know, we're not going to run out of wheat next week. There's grain stockpiles all over the place. But if those shipments don't start up, and as importantly, perhaps, if farmers in Ukraine can't plant, and planting season's 2 or 3 weeks away, it's not very far away, then yeah, we could see $20, $30 oil prices. And as I reminded my subscribers a couple of days ago, if you think back to what happened in the Crimea, if you think back to Arab Spring, the real driver for Arab Spring was actually what happened in the Crimea, because there was a temporary stoppage in grain shipments. Grain prices went through the roof. That food inflation was really what set off most of the Arab Spring. So, I mean, not to freak anybody out, but you know, there is definitely potential for that to happen. And if you look at this chart that shows it's oil on the right, wheat on, it's basically food inflation on the left. And there's 2 versions of food inflation. One of them is food prices in the U.S. One of them is food prices in the EM currencies. In U.S. currencies, it's basically back where it was in 2014. What really kicked off Arab Spring. If you look at it in EM currencies, you know, whether those countries can pay for it in their own currency or not, it's probably questionable. But if you look at it in those terms, it's already quite far past where it was in 2014. So, not to be alarmist, but this is something people have to have in the back of their mind. It's not just about what's going on in the Ukraine. There are definitely secondary and tertiary effects starting to ripple out already, and we may not actually see the impact of those for 3 months or 6 months or 9 months. But there could be some bad shit coming in some other areas as well. And before I go into specific metals and stuff, I just thought I'd scare you with this map. This map is put together by a guy named Peter Zion. Peter is basically a geopolitical historian / analyst. He's a pretty smart guy. And what this map shows, the dark red is basically the current boundaries of Russia. The successively lighter shades of pink, right to the edge where you see that dotted line basically on the left side, that would be Russia / Putin's desired borders. And I stress that desired and planned are two quite different things. Do I think that's where Putin wants the borders to be? Yeah, probably. I mean, people just think back to the Second World War, but they forget that Russia has been invaded probably 50 or 60 times from several different directions. It's actually geographically, I'm not as all in on the whole geography as Destiny to the extent Peter is, but he's not wrong. If you look at the geography from the standpoint of a military strategist, it's terrible for Russia. I mean, there's like 9 gateways where you can easily get in. And basically what those outside borders do is they take you to the Carpathians, they take you to a couple of river valleys. It's defensible positions. Do I think Putin would like that? Yeah. Do I think he's literally trying to get there? Not really. And honestly, I think it's very unlikely now that he's even thinking about stage 2 of this. And we can thank the Ukrainians for that, because they've made his life a hell of a lot more difficult than he thought it was going to be. So I don't think his Politburo, I don't think his generals would go along with this. But that's just, there is a logic behind what he's doing. It's not about they're going to join NATO. That's all a bunch of crap. This is something he's been planning for a long time, I think. Now, if you take a look at this, there's 2 charts there. One of them is the S&P, obviously. One of them is crude oil. You can see that there's definitely a bit of an inverse relationship. Well, it didn't really kick in until the last 2 weeks, not surprisingly. News out of Ukraine both flattened the S&P a little bit and of course gave us that jump in oil prices. I don't know how much oil comes back. It's already had a pretty good dip back to about 105, but it's an issue even in developed countries. Oil is not as big a part of the economy as it was 20 years ago or 40 years ago, but it's big enough that gasoline going up $1 a gallon or $1.50 a gallon, and then food inflation is on top of it. That's directly bites into disposable income. It's not going to put a bunch of people in the poorhouse in the States, but it's definitely going to decelerate things. We're already seeing some deceleration, and if oil prices stay up, I think the odds of at least a mild recession late this year are currently pretty high if things don't moderate. I don't think it would be much of a recession in North America. It would be probably worse in Europe, and Russia probably went into a depression last month. It's going to be a long time and should be. This is hot off the press. I just threw this slide in this morning. This includes this much CPI reading. It came in pretty much as a consensus expectation, 7.9 annually, 0.8% increase monthly. This is broken down so you can see that. I suppose I could use this thing, right? Let's see. No, that's not going to do that. Okay. There is no pointer in this. Never mind. You can see the green one, basically the top bunch of brackets. That's the energy price. This month's CPI reading really doesn't account for any of what happened since the invasion of Ukraine started. Maybe a tiny little bit, but not much. So I think both the food component, but especially the energy component, you're going to see that top really stretch out over the next 2 months. I would think headline CPI is going to get to 9 or 10% in the next 2 or 3 months. That's a pretty big jump, and it's not a jump. It's not a jump the Fed's going to get ahead of. I mean, I know there's been there's been rumors flying around Wall Street that, maybe the Fed's not going to put rates up at all because of what's going on in Ukraine. Like they're definitely going to put rates up. They got way too big a bridge to gap here. I don't know that they'll do 50 points, although I suspect they're thinking about it right now. But it's, I expect 5, 6, 25-point increases. How many is really going to depend on what happens to growth over the next 2 or 3 months. If the oil price and the repercussions from the Ukraine really start stalling things out, then yeah, maybe they stop after 3 or 4 increases, which is not going to do them a hell of a lot of good when it comes to increasing real rates. Because I think we see things top out after another 2 or 3 months, but it's certainly not going to, and CPI is not going to come down at the rate that I would have expected it to a month ago even. It is going to come down eventually, but it's going to be a much more shallow slope than I would have thought a month ago. So negative real rates, bigly, those are here for a while. And like I said, I don't think it's baking the cake, but if this goes on, if what we're seeing for the last 3 or 4 weeks goes on for another month, then yeah, I think we see a mild recession. It's just going to be too big a dent on disposable income. If oil sticks around even 100, I think we're probably okay, because it's just not as big a part of the economy as it used to be. It's not going to be great. We're not going to be thrilled. We're all going to be paying $4.50 for gas, but it's not. I don't think that would stall the economy right out. But right now, if you look at the GDP now coming out of Atlanta Fed, the reading right now is about 0.05, and that bounced a couple of days ago, and it doesn't really have today's data yet, so that may go right back down to 0. They really, this is not a place you want to be if you're a central bank. If you're kind of backed into the corner like the Fed is right now, and you need to raise rates because, a big part of the reason why inflation is part of their mandate, it's not because they care that much about CPI in and of itself in isolation. It's because when you get this kind of inflation move, it bites into the disposable real income of everybody in the country, and that's the problem for the Fed, is they know that this is literally cutting into everybody's budget, so they got to at least make an attempt to stop it. But if you're a central bank and you're raising rates into a decelerating economy, that is not where you want to be. That is the last place on earth you want to be if you're a central banker, because the odds of a policy mistake go up exponentially. So that's the reason why I think there's a decent shot of a recession later this year. So negative rates, things slowing down, oil up, inflation up. Where does that leave us with gold? I know there's probably a lot of generalists, with good reason, I have to admit, especially if they really weren't paying attention until 2 weeks ago. They look at the gold price, and I saw a lot of stuff from generalists in the last 24 hours going, okay, well, that was it. Gold's over, done. Move on for the next 5 years. Not so fast. If you take a look at this chart has 2 arrows on it added by me. The green arrow is the trend. That trend started at the start of the year. The trend is not there because of Ukraine. The blue vertical one, that spike, yes, that is Ukraine. Like, duh, of course it is. So yes, we might have it come back a bit because of that, but the main trend is due to the fact that we've got accelerating inflation. We've got a Fed that's going to start raising rates, and historically, you'll see this, it's a little hard to tell on this chart, but the next chart will be a little more helpful. If you look historically, if you go back, contrary to what might seem like common sense to a lot of people, interest rate periods of interest rate increase and Fed tightening tend to be positive, not negative for gold. A lot of people that don't look at this stuff, they just assume it's negative. But the truth of the matter is, central banks in general are always behind the curve. They're never going to be that far in front of this stuff. And especially with what we've got now, with a renewed acceleration, they're definitely going to be behind the curve. We're talking about very, very negative real rates for a while. This is a more isolated view. Each one of these colors is a Fed tightening cycle. It's the last 6 of them, basically. You'll notice 3 of those cycles, there's a significant percentage increase in the gold price. One of them was kind of flat. 2 of them were down. But the two that were down, those are the oldest ones. They're both tightening cycles during the 80s. The difference between the 80s and now is during the 1980s, you were dealing with very rapid tightening cycle for interest rates and very rapid fiscal tightening where the government was really slashing spending. You know, that's obviously not where we are right now. And I don't think there's any chance whatsoever of us being in that space where we're going to have monetary and fiscal tightening simultaneously. In this cycle, that ain't happening. Like, it's just not. So I'm not worried about that. I'm expecting one of those versions that you see on the top happy side of the chart for us. You know, I think 10, 15, 20% increase in gold prices and other precious metal prices during that cycle seems reasonable to me. I hate doing gold price forecasts because it just makes me look like an idiot every time I do it. But, you know, just take those numbers, 2,300, 2,500 by the end of the cycle. That would be totally unsurprising to me. That's kind of what I would expect. So I'm obviously not bearish on gold right now. Base metals, you know, there's nothing to dislike about any of these charts. Obviously, they all look pretty good. All of them got some love starting, you know, last year really for almost virtually all of them, in part due to supply chain issues, as we all know. That was starting to ease before all this stuff started. And I seem to be missing, okay, let me just check here. Yep, one of my slides disappeared. All right, whatever. But this gives you the basics. I mean, you can see, you know, copper, zinc, those are normal-ish. Yes, there is a spike. This is actually, you know what? These are old charts. I don't know where my new charts disappeared, but there's spikes in those. Nickel obviously is retarded for, you know, basically short squeeze reasons, but all of them were in uptrends anyway. And I think that continues. These charts are from November. I have no idea where that slide disappeared to. The slide that's not in here was a map that showed you smelter locations, worldwide smelter locations. I just had the one for copper. One thing that I think surprises a lot of people, because they don't really think of Europe as being a, you know, that industrial anymore. There's a lot of smelters in Europe for zinc, for copper. You know, there's a few nickel ones too, I think. And one thing to understand about the smelter business is your biggest, you know, aside from obviously the concentrate that you buy to smelt, your biggest cost input is power. Smelters use huge amounts of power. Right now, if you're a smelter in Europe, you're screwed. You're screwed. Because if you look at the basically spot power prices, spot electricity prices, I mean, obviously most of these guys have some longer term contracts, but some of it is spot too, and I don't even think that's by choice. I think it's just because of the size of their usage. I think they're forced to buy some of it spot. Spot prices right now are about 10 times what they were 2 months ago for power in Europe. So that's brutal for these guys, because most of them are locked into long-term TCRC contracts. I think there's probably some force majeure, but still a lot of these smelters, they're either running part-time, and some of them are just saying, you know what, call us in 3 months when the power costs come back down. So the supply side issues, and definitely for, say, zinc, part of the reason why zinc went from like $1.20 to $1.60, a lot of that was this issue. The last 20 cents was Ukraine, but this issue hasn't gone away, and in fact, the whole situation in Ukraine's made it worse. So we've definitely got supply issues for zinc metal, for copper metal, for nickel, for lead, all of them. So even though I am concerned about, you know, we maybe see a mild recession late this year, I pretty much definitely see one in Europe, I think. And I'm also concerned about metal prices getting to the point where there's going to be some demand destruction. I'm not sure even that's going to overcome the supply stuff. So we might see some pullback in base metals, but maybe not much. And they could actually just keep going higher. The supply situation could be that bad. I mean, I don't have real-time information from the smelter sector, so I don't know. I know it's bad. I just don't know literally how bad specifically it is. And this may or may not be a new slide. It's not really a new slide now. Okay. Whatever, the one that went to Matt ended up not having the 3 new slides in it, or not the newer slides, but it doesn't, you know, summarize what I just said. Basically, nobody knows anything. That's the situation. Things are going to swing hugely over the next 2 or 3 months, but keep in mind there's a trend and there's a spike. So a lot of what's sort of getting people really jumpy over the last couple of weeks are spikes. They do not change the upward trend that we've got, especially in precious metals, but in base metals as well. Those things were all in uptrends before Ukraine happened. I don't know, how bad things get or whether we actually get a recession is largely going to be dependent on, I think, energy prices more than anything else. Do keep an eye out for secondary and tertiary repercussions, because I am afraid, unfortunately, we're going to have some of those. If we don't get some kind of solution on the food side and the food inflation accelerates, that's probably going to create some problems in a few spots in the developing world, potentially big problems, unfortunately. And that's about it. I mean, I'm basically, essentially, I'm bullish, but, in markets like this, people are going to be very emotional, and you're not always going to see things catch up right away. I know a lot of people are frustrated that the smaller companies, like, how come they're not catching up right away? It's just because the level of volatility and the level of background risk is so high that people are, you can definitely see it coming down the food chain in terms of both pricing and dollar volume and trading. So I think it is going to keep coming down the food chain. However things go in the Ukraine, it's probably not going to be the first 3 pages of the first section newspaper for the next 3 months, no matter how things go. Like, that's just how the world works. That stuff calms down a little bit. I still think we're all probably going to have a pretty good year, and I still think explorers that make discoveries and developers of strong projects, they're going to be fine. I just hope everybody in Ukraine's fine. Glory to Ukraine. I hope it works out for them.